Hello, everybody. Today I am continuing to discuss tax strategy and savings through rental property investments. So today I wanted to talk about the biggest tax saving strategy that can be used on rental properties, and that's called cost segregation. Um, so to begin with, this is really depreciation. And when you buy anything for your business, you get to take depreciation on any, I guess anything large. Really it's anything physical. The IRS has some very extensive regulations over depreciation, and they have different categories for pretty much everything you could possibly touch that would be something a business would buy. For example, stationery, computers, typewriters, calculators, cars, trucks, buildings, land improvements. There's a plethora of things that they have put into the depreciation codes. Well, depreciation would be basically the concept that you can write off the value of something over time, uh, because its life will last for more than 1 year. For example, you buy a car, let's say you buy a car for $50,000. The IRS says, well, that car should last you 5 years. So you get to take approximately $10,000 of depreciation for each year of the 5 years. Now, actual lifespan of something may last significantly longer or less than what the IRS has said, but they have regulated it to the point that you don't get to pick. It's literally, if this is what you bought, this is how long you get to depreciate it. And they do get, there are some more complicated formulas in it than what we're going to talk about, but for basic math, we're just going to assume easy math for back of the napkin. Okay, so when you buy a residential rental property, whether it's an apartment complex or a single family house, you get 27 and a half years. Now, I don't know why they picked 27 and a half, but it about approximates the 30-year mortgage. So we're just going to round up to 30 to make it easy math. So the idea would be that if you took out a 30-year mortgage to buy a $300,000 home to rent it out, that the principal repayment on that money that you borrowed is not tax deductible. So you borrowed money that was not taxable income, so the repayment of it is not a taxable or a tax deduction, a tax expense. Um, Instead, we take the value of the house, $300,000, over the lifespan that the IRS gives us. Like I said, easy math, 30 years. So we're going to get approximately $10,000 depreciation a year. Now, there's going to be a lot of other expenses that you have associated with renting this house out. For example, property taxes, insurance, um, interest on the mortgage, maybe some repairs, advertising, management fees, stuff like that. But for all intents and purposes, those things are going to be pretty much immaterial when it comes to back of the napkin and actually calculating a general number of what you're going to owe on taxes. So we're going to assume, okay, well, if you take regular straight line depreciation, that's going to offset your principal repayment. And let's say you're getting $1,000 a month in rent income. So you're going to make $12,000 for the year as rent income. You're going to get $10,000 in depreciation. So you're going to report a $2,000 taxable profit with the idea that that depreciation offsets the principal repayment. And so you're going to have cash flow about $2,000. So the idea is that you take regular straight line depreciation to try to match your taxes to the real world economics of what's actually happening. So that's one method. Typically, we want to use that method if you're buying a property that you plan on keeping for a long period of time. So we use regular straight line depreciation to average out the depreciation throughout the entire lifespan of this building. That way you can average your taxes for the next 30 years. So you don't have a significant up or down. The other option is what we call the cost segregation. So in a cost segregation, we say, okay, yes, I have a house that I bought, but this house is made up of a bunch of subunits of property because the depreciation regulations are so extensive. So I can come into this house and I can say, well, actually, I have a roof, I have drywall, I have sheet studs and concrete work. I also have appliances and carpet and an HVAC system, an electrical system, and a plumbing system, and a whole bunch of other stuff that goes into this house as a whole. Well, each of those subunits of property per regulation, IRS regulation, have different class lives. They have different lifespans. So I'm going to take this $300,000 home historical price. I'm going to divide it between these different subunits of property. And so basically, we're going to allocate like $10,000 to appliances, $10,000 to electrical system, and so on and so forth. Well, the idea of when we do that is because of the different depreciation lifespans on these different categories, we're going to end up front loading about 40% of the depreciation into the first 5 years of the property. Now, we are going to just round up to 50% for easy math. So that means we get to take on a $300,000 home, we're going to take about $150,000 of depreciation in 5 years. So that means about $25,000 of depreciation for the first 5 years, each year for the first 5 years. So when we do that, if we're still getting that $12,000 of rent income, now I have a depreciation line of $25,000. I'm going to create a $13,000 loss on my taxes, even though cash flow wise, I'm hoping to be about $2,000 cash positive every year. Well, if I've created a $13,000 tax loss and I'm in, let's say, the 30% tax bracket, that's going to save me about $4,000 on taxes. So not only am I being $2,000 cash flow positive, I also just saved an additional $4,000 on taxes. So the actual net that this rental property has created for me is about $6,000. So that's another way we can take aggressive stances on rental properties. So that's pretty much all I wanted to talk about today. Next week, I'm going to talk about like-kind exchanges and how we can defer capital gains. So next week, tune in and we will talk about 1031 like-kind exchanges. Have a great weekend.